So it would not surprise you to see markets make new lows, but will it be quick? And I would say this also relates to the recession. Is it short and shallow, or is it long and drawn out?
So
Um,
I think again, it's not always clear. I think it's short and sharp. Um, you know, yeah, I think it's short and sharp. I think consumption holds up okay, but not in the big ticket items and stuff like that. We've seen the confidence has collapsed there. But I think it's short and sharp, and I think equities bottom maybe 6 months before the economy, and therefore I'm looking for, if we do have another sell-off, it's short and sharp. So it's kind of this August, September, October period is peak risk for equities,
mm,
maybe even shorter term than that, maybe just July and August. But
yeah,
let's see. I can't get good odds on it yet. But that's how I think it plays out. But it'll definitely bottom out before the economy will,
that's a time of the year too that could
because
be tough
they
for
will be
markets.
looking at the bond market, which is already pricing in rate cuts. It's already starting to price in a Fed pivot, and if the 10-year yield breaks lower as well, it's giving you the information that okay, something's going to change at the Fed, and therefore the equity market will pick this up pretty fast.
Macro guru Raoul says that the digital asset markets could be gearing up for a major trend reversal to the upside if one main metric is any indication. In a new market update on Real Vision, Paul says crypto markets are mostly driven by the liquidity that comes from M2 money supply. Raoul also explains if the Bitcoin market bottom is in yet or not. Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul gives his macro thesis on the global economy conditions and exponential age. He reveals whether we are in a bear market rally and what are the chances of a recession. So without wasting any more time, let's dive right into the video.
Is this a bear market rally? And I think they're asking that about equities as well as crypto.
So in crypto, I don't think it is. I think it's the foundational rally that starts it all off. In equities, I'm not sure. My hunch is, because of that year-on-year rate of change that I showed you, that it's not quite fully pricing in where we should be going. We might have another leg lower, or it might squash along the bottom. And because of the year-on-year comparisons versus last year, in 2 or 3 months' time, it kind of maps that. So I don't know is the answer, and I wish I had a better answer, but I don't. I'm pretty 50-50 on that one. So
Yeah.
that's why I'm not involved. As I said, I am involved in those long duration stocks, but in the bulk of the market, I'm like, I don't see a good short opportunity here, and I don't see a good long opportunity here. Feels 50-50.
While many crypto investors focus on the Bitcoin halving, which is when the amount of Bitcoin issued per block rewards get cut in half, Paul says M2 likely plays a bigger role. Crypto isn't driven by the business cycle, but it's driven by global liquidity. So this is the global M2 deviation from the trend. So it's the rate of change of M2 and how far away it is from the trend. And it's about 1.5 standard deviations away from the trend, and it's turning higher. That time it ever happened, both at the top and the bottom, leads to the turns in the crypto markets because liquidity drives crypto. Remember, this is not a cyclical asset, so it doesn't go back to where it was like oil and commodities. It's a network adoption model that goes up and to the right over time with these big volatile bands.
Here's a learning story about this. Good friend of mine, great trader, 2001, saw the recession coming, saw the bear market coming, oversized his positions, got caught out in the bear market rallies, shorted again, got caught out again, was down 35%, and basically had to close his fund, even though he was dead right.
Yeah. Well, that's the thing, isn't it?
A lot of people have the narrative that this is driven by the halving. Now, maybe the halving, which is the reduction in the supply every 4 years in Bitcoin, is a factor because it's correlated with liquidity. So what you're doing, you put more liquidity into the markets, it leads to more people able to allocate capital into a low supply environment, which is the halving.
I actually think the setup in the US is different. I thought this for a long time. That was my base case going back to 2001. I thought that's what we'll do. But really, we have two mechanisms that nobody else has in the US that makes it dynamically different. Three. One is buybacks that generally don't exist anywhere else. So buybacks drive share prices higher over time. It's basically a reduced supply of equities. Secondly, or enforced demand. Secondly, we have 401ks, which in the US are heavily allocated to equities. In Europe and Japan, they're heavily allocated to fixed income. Because the populations are slightly older, so generally people want a fixed income. It's a different risk tolerance, and laws were made to do that as well, to try and protect people from the volatility of the swings. So that's another thing, and there's a larger millennial population in the US that's now coming into their 401k savings, and that piles into the market and drives things higher. Thirdly, the US has the world's reserve currency, and when it debases its currency via quantitative easing, that drives the US equity market higher. So I don't believe that the US equity market will do what Japan and Europe did, most likely. I don't say it's a zero chance at all, but I don't think so.
Raoul Pal also shared his thoughts on the Bitcoin halving and macro influence over the Bitcoin cycle. Is the accepted narrative of the Bitcoin halving cycle what drives the Bitcoin cycle and all crypto, or is it the macro? Paul said, before adding, I'm starting to think it's all about the macro. Before this recent bear trend, there wasn't much of a debate over an influence the Bitcoin halving cycle has, which sees miner rewards shrink. It was largely accepted as a major factor considering how similar the 2021 run was to the 2017, though the same could be said about the similarities between Bitcoin's price and macro factors.
It's the second part of Tim's question. When are we buying EM and going to the beach? LOL, cheers.
You can't until the dollar falls. And the dollar, I think, goes higher, and I don't see a situation where the dollar goes much lower yet. It's a real problem, and I can't get to grips whether we have the really toxic dollar rally now, or whether it's in a year's time or 2 years' time. I do think it goes higher. So the DXY, let's say, goes to maybe even 120, which is pretty nasty. But my God, if we start breaking through 120, let's say we correct for 6 months, 9 months, and then we go through 120, well, then we're into kind of blue sky territory. And then, I fear of something like a Plaza Accord agreement where people have to say, right, enough is enough. We don't want the dollar as our trading currency. And eventually you see the dollars collapse. Then you just buy emerging markets and go to the beach. I just don't think we're there yet. I just don't see it. Yes, we're going to raise rates, but no, we're not going to raise rates. And actually we'll end up printing money if yields try and go higher. So they are painted into a corner. And I think they just wanted to try and change inflation expectations in Europe. But they know that they can't raise rates. I mean, they just can't have positive real rates in Europe without breaking everything. I mean, the banks have already been under pressure again and again and again. It's not good. So, yeah, it's a mess. But I don't think yields go much higher. So I think Europe might get this stress because it's got larger economic problems. So I think they only have a short period of time where they might have to do what Japan's doing. But don't forget, if they're going to have to buy Italian, Spanish, Portuguese, etc. bond yields, well, the euro's going lower, which doesn't help with the dollar because that drives others. So, it's very macro. It's not 100% clear yet, but we need to keep our eye on all of this. These are the nuances that can turn things pretty ugly, pretty sharp elsewhere.
As Paul points out in this chart, which compares M2 deviation versus crypto market cap, there's a strong correlation between the two. As you can see, the market cap highs of 2013, 2017, and 2021 all collapsed in the following year. Certainly the performance isn't the same between the cycles, but when the macro flatlines, so does crypto.
It's not my base case because I look at the 1947 variety after World War II. We talked about this already, where everybody, after World War II, there was no supply chains and everybody came into the civilian labor force again and prices rose 20%. 18 months later, CPI was negative because growth had collapsed. I hear what everybody says, the supply issues in commodities, but there are now demand issues too. And it depends how far this demand issue, because commodities, this may last longer. Now, if oil stays down at, let's say it gets to $80 and stays there for a year, because demand's still weak around the world, obviously, because we'll be in a recession, well, then the year-on-year rate of change of oil is massively negative after a while. So the inflation pressures come down. Now, does core inflation come lower? What happens to wages? Well, it remains to be seen, but we're seeing job cuts already. We're seeing changes in the economy. Things like mortgage rates will come down. Owners' equivalent rents will come down. They're all lagging. And as is CPI, and I think we'll see unemployment rise. So we've already seen agricultural commodities get cut in half. So remember, there was the narrative, peak fear was Peter Zeihan speaking to you saying, we're going to a global food crisis. Well, after that, food prices halved.
As we pointed out then, the parallels are striking. Crypto has largely followed macro this year. As interest rates changed and a war sprung up, the Bitcoin as inflation hedge never materialized. It was just like any other risk-on asset. But that's not necessarily a bad thing. Considering how early everything is in crypto, there's still time for hard money to become self-actualized. Beyond that, this demonstrates that Bitcoin is part of the investment cycle. It's an actual asset that investors seek whenever the macro tells it to.
It takes a while to come down mathematically too, as Jared Dillon pointed out recently. But I think 18 months, I give a reasonable probability that we have deflation in headline CPI.
So what are your thoughts about the research rally in crypto, stocks, and bonds? Is it a bear term rally or not? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video, and thanks so much for watching.